Hello, everyone. Thank you for joining us today as we discuss 2025 markets review and 2026 look ahead for US expat investors. Before we dive in, a brief disclaimer. Please note that this webinar is for informational purposes only. It is not intended to offer advice or guidance on legal, tax, or investment matters. Such advice can only be given with a full understanding of each individual's specific situation. So, without further ado, over to you, Tom.
Okay, yeah, just to kind of expand on the intro a little bit. I run International Asset Management, which is a U.S. registered investment advisor. I started this firm in 2002, so we've been around almost 25 years and specializing in services for Americans living abroad. So I've done, and if you go on the IAM website, one thing that might entertain you is there's actually all of the annual review and forecast newsletters that I've done over the years on there, so you can entertain yourself by seeing how off I was in certain years. And there have been some good projections too, I hope. Shane is based in Sevilla. Shane runs our European business, and we're one of the few firms that has a company in the US and a company in Europe and licensed in both jurisdictions, so that's very unusual. So just moving right into it, let's first of all have a look at what we said last year and what we looked at, not just our forecasts, but other people's forecasts for 2025 around this time last year. And analysts, economists were generally positive on the year ahead. Obviously, there was a lot of uncertainty around U.S. policies, Trump policies. The tariffs were kind of new at that point, and really nobody knew what was going to happen with those. But economically, there was a lot of positive sentiment, especially in the U.S. And there was a feeling also that the stock market, especially the U.S. market and the technology stocks, was overvalued. And this year that has just continued, especially with the AI and boom and so on, and a lot of people talking about AI and the Magnificent Seven, how their share prices have gone up over the years. The thought was that most of the world wasn't doing that great economically outside the U.S. I mean, China is in a 2008 type real estate crisis right now. The only reason we don't hear more about that is because they have a controlled economy over there. Europe really wasn't doing that well growth wise, and many other parts of the world as well. And partly as a result of these tariffs, a lot of people thought that might get worse. And so the expectation was that the U.S. might outperform, but a lot of uncertainty around the tariffs. And the other thing we were thinking about was that bonds and income producing investments might be attractive because we were expecting interest rates to start coming down, having peaked in our view the year before. And so what we said is, I guess what we usually say is that it's good to be diversified, especially in times of uncertainty, but that we should steer the course rather than becoming overly conservative, overly pessimistic as a result of the political spectrum maybe. And indeed, so what did happen over the years? And here's kind of there's a lot of squiggly lines on here, but basically we're looking at various stock and bond markets, and we have the price of gold here, which gold has done very well. It's the top line there. It's up about 60%. And in fact, silver, which really tracks the price of gold, is up about 200% over 2025. Much more volatile than gold, though. We've had about 10% in gold in most of our portfolios for a few years now. So gold did well last year. Stock markets did well too. But the non-US markets, unlike the projections from a lot of these analysts, the non-US markets actually did better than the US markets. And not only on the stock side, but also on the currency side, as the US dollar generally weakened. And so what we see there is emerging markets as a group were up about 30%. The Chinese market, for all the problems they're having there, was up quite a bit as well. And EFA, that sort of developed non-US markets, that was up 27%. And then you see the NASDAQ up 20% and the S&P 500 up about 16. And then bonds, actually, I mean, they didn't do that well. Despite the fact that interest rates went down, long-term bonds were about flat. I mean, these are stock prices on bond ETFs, so you also have a dividend yield there, which was about maybe 4% on that. So bonds made about 4 to 7% last year, which is okay, but not great. What didn't do well, and it hasn't done well for a while, the bottom one is real estate investment trusts that actually invest in real estate. That was one of the negative things is a lot of things happening in that space with Amazon replacing malls, for example, and also commercial real estate not doing very well in many places too. But generally, a very positive year, and for a diversified portfolio, also very good. So better than a lot of people expected. The projections on the last page, we looked at B of A was projecting 12%, and we were up a lot more than that, despite the downturn in April, which was Liberation Day when Trump announced all his tariffs. There was a big downturn there, but a big recovery after that. And so despite that, markets did very well last year. So in fact, the strategy of being diversified and sticking to our strategy rather than becoming more conservative was the way to go. And then just looking at interesting, speaking about the tariffs, you'd think a lot of people were thinking, well, these countries that are going to get hit with these big tariffs, boy, they're going to have a real problem. Not the case, at least not the stock markets for the most part. The S&P 500 is the blue line, up 16%, and practically everybody else did better except for India. India did worse. Their currency also fell versus the dollar for various reasons. But even the Chinese market in green there, up 26%, and many other markets that have been hit by tariffs, Canada, Brazil, Europe, all up significantly more than the U.S. market. And part of that has been currency, but a lot of that has just also been those markets. So maybe the thought is that while each of these countries or markets areas are being hit by tariffs, the U.S. is really being affected by all of the tariffs it's taking on at the same time. And so maybe that's one thing. And another thing is that I think the technology firms, there's a lot more technology in the U.S. market. It's about 30%. It's about a third technology, the S&P 500, whereas many of these other markets have a very low exposure to technology. And so last year, the technology companies didn't do as well as they did. They still did well, but maybe not as well as some of the other companies like financials or defense contractors and so on. So that's probably a part of it too, is the technology work weighting in U.S. markets. And speaking of technology, here's the Magnificent Seven on the S&P 500. So as we said, the S&P 500 up 16%, and it was a mixed bag. Amazon, Apple, Tesla, Meta, Facebook, right? They didn't do as well as the S&P 500. Neither did Microsoft. And then a couple of others like Google was up 65%. Alphabet was up 65%. Nvidia was up 40% almost. So those two outperformed. But in general, the technology companies underperformed the overall market. So we were seeing a more broad-based rally than we have seen in the U.S. in previous years, because in previous years it was mostly driven by these seven companies in technology in general. So that's actually encouraging in the sense that it's a broader rally, less dependent on these technology companies, although they still make up about a third of the market. And so then, if it goes down and to the right, that's bad, right? And that's the U.S. dollar we're looking at now compared to most currencies. The one that's actually going in the other direction is India. So that's the orange line. The U.S. dollar strengthened versus the rupee, but otherwise it was generally down about 12% versus the euro or the Swiss franc, and even countries like Brazil, which was hit by the tariffs. The Brazilian currency strengthened 10% versus the dollar. So I think that points towards general disenchantment with the tariffs and also other things that are going on in the US. Like right now, we're talking about the Federal Reserve, the independence of the Federal Reserve. All of that, I think, is weighing on US dollar sentiment, and I wouldn't be surprised if that continued into the new year, in fact. So the other thing that was interesting was commodity prices, right? So everybody knows about we mentioned gold and silver. Here's a chart of, you can see silver on the left up something like 200%, and gold is the green line up 70%, and then other commodities did well too. Copper, for example, has gone up, especially recently, because we're expecting shortages in copper and so on. So it's a supply demand kind of thing, and so copper has done well recently. Some of the other commodities like oil and natural gas were actually down for the year. And then what we're looking at here, the sort of brown line, if you like, is what we call the Baltic Dry Index. That is an index that measures the cost of shipping, big container ships. And it's pretty volatile, but there's this saying in the business, keep your eye on the Baltic Dry. And that's because it's a kind of many people feel it might be a leading indicator, leading economic indicator, in the sense that, if there's a lot of trade going on between countries, you would expect these prices to go up, the index to go up. And then in a recession, or when we're getting into a recession, people aren't shipping as much, companies aren't shipping as much, so the index falls, so the cost of containers goes down, supply and demand. And what we've seen, as you can see, it's very volatile, but generally speaking, the Baltic Dry has been going up despite all the tariffs. Despite all the tariffs. So maybe I mean, you can see right at the end, it's gone down a bit lately since say, the beginning of December. So we'll see if that continues. Maybe the tariffs are just starting to hit now. So that could be, but that could be one thing to watch as a leading indicator. And we also watch other leading indicators that we'll get to in a bit. So keep your eye on the Baltic Dry. And so here, sometimes you get the prices of these commodities are going in one direction or another, but they don't always translate into stock prices for commodity companies. But this year they actually more or less did, and so you can see the green line is Newmont, which is a gold mining company. And what was interesting, over the last few years, gold has been going up for a while, but the price of Newmont stock actually didn't go up that much. But this year it went crazy. So luckily we own some Newmont. But you can finally see that they're starting to benefit. These companies that are in the business of mining gold or copper are finally benefiting from some of these higher prices. The SECO stock price, that's a copper miner in Peru, and that's up almost 70% this year. Just recently, it's gone up a lot with the price of copper. FRO, the purple one, that's a company that ships mostly oil and natural gas and stores it offshore in large vessels. So it's done pretty well. It pays a nice dividend yield as well. And you can also see, though, that the stock price of, say, LNG, Cheniere, which is a gas producer in the U.S., and has gone down, and Exxon has gone up, but less than the S&P 500. So you can see that the oil and gas companies have generally not done as well, which makes sense, because oil and gas prices have been down. So in fact, it was a year where the fortunes or the stock prices of these companies did in fact reflect the underlying commodity prices, which isn't always the case. And so what are expectations going forward? Well, here's what the so-called experts are saying, right? The analysts from the big firms are generally positive. They're upwards and to the right is generally in the 7 to 13%. They're expecting gains on the S&P 500. Everybody is generally positive, as they were last year. And, that's kind of an average return for the stock market. Like 10% is about an average long-term return for the S&P 500. what they are saying well, we'll get to that in a minute, but yeah, just having a look at that. So generally positive despite the tariffs. And most of this comes from listening to things like earnings calls. That's what these people do. They listen to earnings calls. We also listen to earnings calls. I listen to probably about, I don't know, 20, 30, 40 earnings calls every quarter. And when you listen to earnings calls from a company like, say, Visa, the credit card company, you get a nice perspective on what's going on in the world, both economically and geographically, because they operate all over the world, and they're in the they're in the credit business, so you can get a sense of like, are people extending their credit card debt? Are they shopping less or more? And it's generally been positive for Visa all around so far. So we have to keep our eye on these things, but this is why the analysts are positive, because generally speaking, earnings calls for most companies, for many companies, have been positive. Now, interestingly, some of the companies, like for example, Dollar Tree in the U.S., which is sort of a budget retail company, I guess, that stock price has gone up lately, and so there's a concern when you see that people are going more down market, that maybe a recession is coming. But from what it looks like is that it's kind of a K-shaped economy in the U.S., as we say. That is, the rich are getting richer, the poor are getting poorer, and it's mostly the economy. The people that are suffering are lower income people, and but the higher income people are spending. You can see that in cruise lines. Their share prices have gone up. People are traveling, and those are the people that are generally invested in the stock market. So it's generally positive for investment markets, even though there's a big segment of the population that is being affected by tariffs and inflation and not unemployment yet, but maybe unemployment in the future. So that kind of a thing. That's really what I think is going on, at least in the U.S. market. And and then projections for gold, because gold has done well for a number of years now. You can see the chart in January of 24, it was at 2,000. Now we're at 4,400 beginning of the year. And so the projections for that are more nuanced in the sense that if you take the average of those projections, they're expecting gold prices to pretty much go sideways this year. But there's a big range of expectations there. And in fact, since the beginning of the year, as of yesterday, gold's up about 6%. So that's how we're starting off. And personally, I think I don't want to pick a number, but in general, I would say as long as there's uncertainty, and certainly there will be uncertainty this year in many instances, politically and economically. We've already seen some of that. As long as there's uncertainty, it's not too bad to have a little bit of gold in the portfolio, because it tends to provide diversification. It tends to do well in times of uncertainty. And so here's kind of a summary of what these people are saying. These analysts are saying S&P 500, they're expecting to go up maybe about 10% on average. And stocks outside the U.S. are also expected to go up, but less, which is interesting, because I'm not sure I agree with that, to be honest. Because for one thing, I expect the U.S. dollar might continue to weaken a bit. And for another thing, I think maybe the Magnificent Seven and the technology sector might not do as well as the broad market, and the U.S. is heavily tech weighted, whereas places like Europe and the UK and many other places have less in technology. So I'm not sure I agree with this, but in any case, the projections are generally positive. And so the other thing we look at in terms of making projections is what we call leading economic indicators, and this is the US one. There are some for other markets as well. But the leading economic indicator is sort of a composite of a number of indicators. The indicators being, well, the stock market is one of those leading indicators. But it's also things like new orders for machinery, things like unemployment rates, that kind of stuff. And so I think things that drive the economy and that kind of move before the economy enters into a recession or starts doing well. So that's why they're called leading. And then you have coincident indicators, which is actually just four things, and that's more like what's going on in the economy now. So what are actual payrolls? Are people losing their jobs now, or unemployment benefits going up? Uh, Things like that. Things like what is the trade now as compared to trade projections for leading indicators. And what we see is the gray areas are recessions we've had. So going back to the dot-com bust in 2000 and then 2008, the Great Recession, and then in 2020 we had just a brief sort of COVID downturn there. But you can see from the two main recessions there, the dot-com and the 2008, the leading indicator is in fact leading the recession. It goes down before we get there. And then you see the coincident indicator turn as well. And you can see that it in fact is coincident. It starts going down when the recession hits, when GDP starts decreasing and maybe getting negative too. And we haven't seen that yet. I mean, we've seen the leading indicator go down a lot. It's been going down since, I don't know, what was that, 21, 22, maybe, beginning of 22. And if you recall, 2022 was a down market, a down year. A lot of the technology companies went down a lot, but it was a down year broadly in the US investment markets. And the leading indicators have kept going down. You know, people are not, consumer confidence is one of the leading indicators. People are not confident given the turmoil politically and economically. But what we haven't seen yet is that coincident indicator start heading south. And so that's one thing we're watching for when that starts heading south. If it starts heading south, then that'll be one of the that'll probably be a time where we get more conservative. But the other thing that might happen is people, we might just live through this, and those leading indicators, people might get more confident. You know, maybe we'll have peace in Russia. Maybe we'll have peace in the Middle East. Maybe the tariffs will get sorted out, and we'll get back to a little bit of normalcy and so on. So it could go either way right now. So it's worth watching. But for now, I would say steer the course, be diversified, and if you're more conservative, then maybe you want to focus on income investments. But before we get there, why don't I hand it over to Shane so that he can talk a little bit about Europe specifically?
Yeah, thanks, Tom. So the way we kind of wanted to break this up is Tom covered the US and the rest of world. Since I'm in Europe, our company's in Europe as well. We're going to look at Europe as an individual piece here. And the European markets do act quite a bit differently than the US markets. And we're going to kind of, delve into some topics here. So one is what's going on economically in Europe in 2025. We'll look at some specific country examples, some of the big ones. Spain, for example, is one of the leaders. And then what we think is going to happen in 2026, and then what happened in the stock market in Europe in 2025. It was a big year. We're pretty excited about the European market last year. So jumping in here, the Eurozone in 2025, when we look at what really drives, the economy and really everything in terms of work, employment, everything else, it's inflation, interest rates, the central bank. So the big concern going back to 2024, going into 2025, was what's going on with inflation. And Europe had a really big issue with the cost of energy. With the war with Russia and Ukraine, they had to import a lot of energy. A few years ago, Germany made a strategic decision to shut down their nuclear reactors. So they had to then switch to coal and natural gas. So this created a big kind of crunch on energy, which pushed up a lot of inflation. All the costs went up for everything then. So that was a big concern. But the good news is inflation was under control. So inflation came in, close to the target of 2%, around 1.9% at the end of 2025. So that was great. We had good GDP growth in Europe. And because inflation kind of got under control, when the independent central bank decides what to do, they're trying to do two different things. They're trying to fight inflation, or they're trying to stimulate growth in the economy. If inflation numbers are hot and high, then they need to raise interest rates to fight that. If there's a recession or there's high levels of unemployment, they want to lower interest rates So money's cheaper to stimulate investment, stimulate lending, and get the economy rolling. So from an economic standpoint, things are improving over here. Inflation was close to target, so the central bank actually cut rates. So now it's around 2% over here, and that stimulated some growth. And also from a debt standpoint, which we'll talk about, is hoping to improve that picture. So then the 2026, European Central Bank outlook, most analysts expect the bank to remain flat where they're at right now. They don't expect an increase or a decrease. That's subject to what happens largely with the labor markets. If there's high unemployment, they'd likely cut rates again. But so far, we're anticipating no big changes there. And then this was looking back, going back a couple of years at inflation. So, like I said, the big cause of inflation over here was energy costs. And that's going back, to the war a couple of years ago when it started. You can see it really spiked around 10% just after 2022. And now it's down to the target, which is around 2%. So that's a big bonus there. And then looking at, how they measure inflation. So in the US, we're used to hearing the CPI. That's the Consumer Price Index, and that's a basket of goods which measures inflation. There's also the core, which is stripping out energy and the cost of food. And in Europe, they use the HICP, which is the Harmonized Index of Consumer Prices. And what this is interesting in that they try to make it so you can compare across countries because each economy is quite different. So that is the number I quoted at 2% late in 2025, which is a nice figure. And also core inflation declined as well when we stripe out the energy and food prices, but not as much. And part of that was from services. So there's a saying in economics that wages are sticky, meaning they're slower to respond than other things in the economy. And that was the case over here as well this time. So again, we cut rates. That was good. Looking at individual countries, the big economies in Europe, now that the UK has left us. Germany, they still continue to have issues around having enough energy, excuse me, to get their manufacturing really going like they would like to. And that's been a big drag on being able to export some of their industrial goods. But that is beginning to stabilize, and I think people are becoming more optimistic about that going forward. France, and I don't have Italy on here, but I'll include Italy as well for one of these points. They've had moderate growth. They've had a lot of domestic demand for their goods. The big issues there are fiscal deficits. So, over here, there's a lot of the governments take kind of a socialist view where they pay for a lot of goods for people and they treat it as a public good. So, in the US, we often treat things, even if it's a public good like healthcare, we treat it as a private expense. Whereas over here, those are all public goods. And then to finance that, it's either through tax dollars or debt. And there's been a lot of debt. So that's the big question is can France, can Italy continue to add debt at the rate that they're going? With interest rates going down, that's better because it's going to be a lower cost to service the debt, but it's still a big question. And then the credit quality of that debt also comes into question. But Spain is, thanks to us, doing really well. So Spain's economy has grown really well. There's been a lot of tourism, a lot of services, a lot of EU funds being invested here to help stimulate growth. There's been some technology investment as well. So that's been a real highlight on the European side. Now, if we're looking at the stock portfolios. So in 2025, let's look at it two ways. I want to look at it from if you're living in Europe, you're investing in euros. Those are the first figures. So the stocks, 600, up 20% this past year in euros. That's in the local currency. If you adjust that and put it in US dollars, it's up 36, 37% because the euro appreciated relative to the dollar around 12, to 13% last year. So that's one of those points, when we have these calls and we talk about mitigating currency risk, this is why we do that. And it can go both ways, but with the dollar weakening, having exposure to the euro has been quite beneficial. And these two indexes, the Europe 600 is large companies, medium-sized, small companies. It's kind of a total market. And then the Euro Stocks 50 is the largest kind of blue chip industrial companies. And that had a great year as well. In euros, plus 22, converting it to dollars, plus 38. So that was quite a nice return over here. This is quite the slide. So this is looking at forecasting the euro into dollars. Now you can see €1 is $1.15, kind of where we're at right now. And this blue line is kind of a baseline if nothing changes. And then the gray sphere there that has quite a spread is the sensitivity for analyst expectations for that. So you can see there's a huge level of uncertainty in what's going to happen with the currency. And currencies, in general, they don't tend to, it's not like the stock market where one just keeps appreciating relative to another for a developed country. They're more mean reverting. So we expect currencies, depending on geopolitical events, they might move up or down from time to time. But in general, there tends to be some currencies that are stronger than others, and they kind of operate in that band. So this is anticipating, anywhere from 110 to 128 over the next couple of years. And this is interesting as well. So something Tom mentioned, the Magnificent Seven, some of the AI stocks, in the news, you hear frequently about the AI kind of tech bubble. And what that's really looking at is the price of the stock to the earnings. So the price to earnings ratio, that's the valuation. So what is the stock trading at relative to its company's earnings? And when you talk about a bubble, I think something that's important to bring up, when we go back to the dot-com bubble in the 90s, those were companies that had maybe zero earnings. They were pre-earnings companies. So when you've got a company trading on no earnings, that's just completely a bubble. There's no hope there for not calling that a bubble. Whereas currently, even with some of these AI companies, earnings have continued to grow. So although the valuations, the PE ratio has gone up significantly, we're still seeing earnings growth. So I think that's something to point out. But then looking at the US market and that compared to European valuations are not that high. They're near kind of long-term averages, which is good. That could be a good investment opportunity. Dividend yields remain higher than the US, generally speaking. And looking at how we compare European PE to the US, we're kind of trading at a discount. So that's an interesting value proposition there. Now, if we're looking at going forward, what are we talking about in terms of a base case? And then what are the big risks? So base case, in 2026, analysts expect GDP growth for the EU to come in around 1.2%. Inflation, the same as it is now, around 1.9. So there could be some gradual easing in 27 if there tends to be some inflation or not inflation, sorry, unemployment. If that kicks in, that could really, lead to further rate cuts here. But we have to kind of monitor that as we go. And then the big risks are energy prices again. If, there's a lot going on in the world right now, so there could be some shocks to oil, natural gas, the supply of some of those things, trade routes. So that's something to monitor. Trade policy as well. If there's some escalation in some of these trade wars, that could also impact energy, among other things. And then fiscal tightening. So that was what I was talking about with France, with Italy in terms of their debt. The EU has rules for debt to GDP ratio for countries. So if they start to kind of say, hey, you can't take on this much more debt, and we saw that in 2008 with Greece, that's where there could be some further decline in growth. So I think key themes, for Europe in 26, if we're looking at three things, it would be kind of fiscal pressure on those, particularly France, Italy, some of those countries to really kind of shape up some of their balance sheets, so to speak, and be a bit more, potentially austerity or conservative, which would impact growth. A lot of times the way they get growth here is through government investment in public goods. And then energy transition, there's a lot of investment in solar, particularly in Southern Europe, which has helped with the transition there, and it's lowered the cost of energy. So as that continues to happen, we should expect more growth. Another big kind of structural issue over here is the population. So it's quite an elderly population, and that impacts productivity, that impacts the labor market for people who are available to work. So that's kind of an issue that we have a hard time, navigating. So then what does that mean for you guys? What does that mean for investors? So I would say in general, we saw what happened with the currencies this year. Europe offers diversification in terms of geographic, but then also in terms of currency, and it's a nice way to get income, the European value stocks. Um, Also, countries matter, more than ever. So I think looking at global geographic diversification is very important. And then specific countries in Europe perform differently than the EU as a whole. So that's something to keep in mind. And as always, always diversify. So I think we're going to turn it back over. Tom and I are just going to kind of talk about some different income producing investments here and what we think is a nice feather in your hat for your portfolio.
Yeah, so a lot of our clients are retired and they're thinking about income, and income can come in different forms. It can come from dividends, it can come from interest, it can it can just come from sales, capital gains as well. So it doesn't necessarily have to be actual income like we think of as interest in a bank account or something like that. But you also want to diversify the income investment. So a lot of when we get new clients coming in, a lot of times what we see stock market investments and we see bond funds and that's it. And so there's a whole bunch of things you can invest on the income side. And the ones we're looking at, they range in on the dividend paying side from 6 to 10%. Some of these we're talking about, say, dividend paying stocks. A lot of the financials, for example, pay pretty good dividends. Preferred shares are sort of between stocks and bonds. You might say they're called preferred shares because their dividends get paid before the dividend on the common stock. So a lot of banks issued preferred shares. For example, you might have Citibank or JP Morgan, and they'll have some preferred shares that they pay maybe 5 or 6% on, whereas the common stock of JP Morgan, I don't know, maybe it pays 3% or something like that. So that's preferred shares. They still go up and down with the stock market to some extent, but you buy them for the dividends. And then real estate investment trusts. So real estate itself hasn't done that great for a number of reasons. But just because it's called a real estate investment trust doesn't necessarily mean it's invested in buildings or commercial buildings or malls. For example, there's a lot of data centers now that are structured as real estate investment trusts. There's a company called Iron Mountain that we've had in the portfolio for a while. They do data storage. They're a big data storage firm. They are structured as a real estate investment trust. And what that means, structured as a real estate investment trust, is that basically the income that the company gets from whatever its sources of income are goes out to investors. A certain percentage, a high percentage of that has to go out to investors in the form of dividends. And that's why REITs pay a pretty good dividend, generally speaking. BDCs, MLPs, BDCs are business development corps. It's publicly traded private equity. We have, I think, 3 or 4 of those in the portfolio. They pay dividends in the range of 7 to 10%. And essentially, it's a company that invests in a bunch of smaller companies. It makes loans to them. Sometimes it takes equity positions. It's investing in risky companies, but it's diversified in that maybe there's 200 companies they're investing in. And this is another gauge, by the way, of how the economy is doing. Because what we see is when we start getting into a recession, we look at these BDCs, we listen to their earnings calls, and we see that maybe some of these smaller companies that they're investing in are not doing so well. But so far, we haven't seen that too much. The default rates are low. Generally, these companies are doing well. And so this is another form of dividend income for us. Master limited partnerships, they're on the oil and gas side generally, revenue from oil producing, gas producing investments. Some of these are structured as corporations, but mostly if they're structured as a LP, a limited partnership, then you might have to deal with things like K1 forms, and you might actually even get taxed on these if they're in retirement accounts, what's called UBTI and related business taxable income. So these are we kind of steer away from these because of the tax reasons, but another form of income for you. So that's kind of a summary, and I don't know what you're seeing on your side, Shane, in Europe, but that's kind of where we're at, right?
Yeah, I think we have an interesting, kind of offering here. We kind of look at the European market in the same way we look at the US, with the value side on the equity positions and the growth side. And on the value side in Europe, that tends to be, the focus for investing in Europe, I think. And those companies are going to be financials, telecoms, utilities companies, stock exchange, things like that. And they tend to produce a dividend that's anywhere between, 5 and 9%. So I think that's a pretty interesting, proposition for getting income, getting exposure to the euro, and also geographic diversification from the US. So that's what I would add on that one.
Yeah, and I would say that we're getting a lot of people these days who are saying, I want to get my money out of the US, right? But
Yeah.
we have to think about, what does that actually mean for you? Does that mean, and our clients are overwhelmingly US citizens living abroad. So what does that mean for you? Does it mean that you actually want to have an investment account that's not in the US? Because that's going to be hard for US citizens. There aren't a lot of brokerage firms outside the US that want to deal with US citizens. You still have to do the US tax reporting. It's pretty hard to have something like a retirement account outside the US. Those are generally US trusts, so they have to be in the US. And then, I mean, we do have a possibility to have non-US accounts with Interactive Brokers, which is one of the custodians we use. The other one we use is Charles Schwab, by the way. But Interactive Brokers for our clients in Europe, if it's a taxable account, we can do an account with Interactive Brokers in Ireland, which is a non-US account, but we've got limitations there. We can't buy US exchange traded funds, for example. So the other way, though, to get that non-US exposure is just to invest in non-US stocks, bonds, even an ETF that trades on the US exchanges, but the underlying investments are non-US. As long as they're not hedged back to the dollar, that's still a euro-based or a non-US currency-based investment. So you can do it that way. It's much easier. So if you're not too concerned with having an account, an actual account outside the US, then that's a good way to get non-US exposure. And in fact, our accounts are right now probably more than 50% outside the US. We generally try to have like a 50-50 balance. A couple of years ago, probably we were more US based, and beginning of 2025, we moved a lot of money outside the US. So that's where we're at on this. Financial planning. Yeah, well, let's talk about that a little bit, because for a lot of people, when they make the move overseas, or if they're living overseas or wherever they're living, even more important sometimes than the investment aspect is the financial planning aspect, because at the end of the day, it's supporting your lifestyle is what it's about. Not just making money, but what's that money used for? Making sure that you don't run out of money if you're retiring or something like that, or if you're saving, or you have other financial goals like saving for a house, for example, or for college education in the U.S. It's expensive. All financial planning matters. Also, cross-border matters. Things like taxation and estate planning are complex in the cross-border sense. So this is the other aspect of what we do is the financial planning side. And although we don't do taxation or estate planning in-house, we're not tax experts, we're not lawyers. We do have what they used to call a Rolodex of a lot of people that we work with, or we can refer you to and work with them on the estate planning and taxation side. And one of the aspects of doing a financial plan is like a personal income statement, balance sheet, cash flow, projecting into the future and incorporating whatever financial goals you may have. But there's also an investment aspect to it, because everybody does a risk profile questionnaire. When you started with a financial advisor in the US or Europe, you do a risk profile questionnaire, but that really just tells you how much risk you might be willing to take in your portfolio. What a financial plan can tell you is what rate of return you might need on your investments to realize your financial goals. So doing a financial plan can also help inform the investment decision.
Yeah, I think, something else, I don't know if you'd call this financial planning or cross-border investment advice, but something else that's really related to this is the coordination, the coordination of services. So for example, say you're moving to Spain, you're moving to Barcelona, there's a wealth tax here in Spain, and you speak to a local tax advisor who advises you to use a unit link insurance European wrapper to hold your investments. That's going to help optimize your wealth tax. Completely legit plan. If you hear that, you're talking to a professional, you think, oh, this is great, I'll do this, it's going to solve my problems. Now, first of all, there's the fees to consider. There's what investment products are going to be in this wrapper. And usually those are going to be mutual funds or exchange traded funds, European ones. Those are what we call PFICs, passive foreign investment corporations. So now if you were to talk to your US tax advisor, he would tell you to avoid this strategy at all costs. If you were to talk to us, we would tell you to avoid it at all costs. But also, not just from a US tax standpoint, but also from an investment standpoint, looking at the fees involved, the products themselves might not have great performance compared to what we could get in the US. There's lockup periods. So I think that is my point, is that coordination of services. So being on a call with both tax advisors and us, and kind of having somebody almost like a general practitioner, in the medical field. So somebody who understands the overall picture for you and can help, kind of guide that process. That's what we do for our clients as well. And
Yeah,
I
so we're getting.
think, yeah,
Oh, go ahead. Go ahead.
I was going to say, I think that kind of sums it up, but still got some questions maybe.
Yeah, that's right. So we got a few minutes, so maybe we could get to the questions, Hugo. And
Yeah,
then, by the way,
definitely.
if I was just going to say, I mean, we only have a few minutes left here, but if we don't get to your questions, you can always reach out to us, and we'd be happy to talk offline.
Mhm.
Well, thank you both very much. We had quite a few questions sent in advance, so I'll read through some of those. Quite a few of them I think have actually been answered in the presentation, so we can skip over a few. If you, as Tom said, if you don't get your question answered, please reach out by email. You can find the two websites at iamadvisors.com and EuroUSAFA.com. And you can find our contact details there and get in touch with your questions. If you'd like to schedule a call to talk about the services and your situation and explore using us, then you could do that via the websites too. So let's jump into some of these questions. First is, what are the risks of having my funds in Europe? And Shane, you were just saying a little bit about that. So maybe we don't need to
Yeah.
go over that again.
Yeah, I can kind of clarify that. So if you move your funds to Europe, there's a couple different issues. One is tax reporting in the US. So they're probably not going to produce 1099s. Presumably the account's going to be over 10,000 or even 250,000. So there's going to be additional US tax reporting obligations. And then what can you get? So usually everything over here is based around packaged products or insurance products. And insurance products, the fees are super expensive. They're not, the juice isn't worth the squeeze. I would advise everybody to read the fine print on what they're actually charging for a platform fee, management fee, fund fee, trading fee, all those things. And then the funds themselves are going to be considered passive foreign investment corporations, PFICs, which are going to be a problem for your US returns. The IRS is going to tax you at the highest possible rate. And in some cases, there's even an additional kind of penalty for that. Um, so I would just say avoid it at all costs, in short.
Yeah, and just to add to that, I mean, the question was Europe, but this applies generally everywhere outside the U.S. for U.S. citizens. If you invest in a non-U.S. mutual fund in a taxable account, it's probably going to be a PFIC, and then you've got onerous U.S. tax reporting and so on to deal with. So, generally speaking, for U.S. citizens abroad, it's better to keep your investment dollars in the US. And then if you want to have some money invested in, say, local currency, well, then you could invest in individual stocks. That would be fine if you could find a brokerage account that you could open. But the other thing you could buy are cash products, things like CDs, term deposits. So your safe money could be invested in euros or whatever, and those things aren't PFICs, generally speaking.
Thank you. Another question is which investments can be stable in this unpredictable world political situation? But again, Tom, I think you covered that, talking about gold and diversifying into different geographical regions. Here's one that I'm not sure we covered, which is how do you keep US-based mutual funds when you move overseas?
Yeah, well, you don't. I mean, so let me put it this way. Some people move overseas and they keep a US address on their accounts just because it's easier to do that. A lot of brokerage firms won't work with non-US residents. And so they find an address. Maybe they still have a property in the US, maybe they're using a friend's address or a mail forwarding address. A lot of people do that. That is strictly speaking not a problem for you so much as it is a problem for the brokerage company because they are supposed to know where you're actually living and they will ask you what is your residential address and probably you're going to have to lie about that if you're actually living outside the US. And if they figure out you're lying about it, then there'll be consequences. They'll kick you out. I mean, you're not going to go to jail or anything like that, but there'll be consequences for the account. So mutual funds, U.S. mutual funds, are investment companies under the law, and as the phrase go, they have to be registered where offered. Wherever you're living, that's where they're being offered. U.S. mutual funds usually aren't registered outside the U.S. And so what ends up happening is that sometimes you can keep the funds you're in. Most often, you'll probably have to get rid of them. Certainly, when it comes time to do some rebalancing, you're not going to be able to buy more U.S. funds to do the rebalancing if you have a non-U.S. address on the account. And so, what we don't use mutual funds anyway because we feel they add an extra layer of fees for very little value compared to, let's say, exchange traded funds. So we use ETFs, which trade on stock exchanges like stocks do. Generally speaking, you can usually use those. You can certainly use individual stocks, bonds, that kind of thing. That's what we use to build the portfolios.
Thanks. Somebody's asked, do you view it at all likely that capital controls may be implemented in the US, prohibiting movement of funds from the US to the EU? And if that happened, would we have time to adjust?
I think we hear that a lot, from prospects and clients. I think that's a big concern these days. We haven't seen that in the US before. And, it's anyone's guess. I don't personally foresee that happening. And I don't think there's been, from the analyst reports that I've read and things, I haven't seen that as a big risk. If that were to happen, then I would say there wouldn't be time to respond. That would be more of in that scenario, I think it would just be whatever you've got outside. But in any case, people say, well, if I move my money outside the US, then if there's capital controls in place, I'm safe. But I don't think that's going to be the case either. Historically, how that kind of works, at least like with FATCA and places like, these types of laws, everybody kind of deals with the US. So I think it's low probability. And no great solutions to kind of hedge the low probability scenario. That's what I would say.
Yeah, I would agree with that. And bearing in mind that because we're mostly Americans and we're worried about things going on in America, we have this perspective, or a lot of people have this perspective that, oh my God, America, is going downhill. A lot of political strife, so on. But let's take a global perspective on this because the rest of the world is not necessarily in better shape, but certainly not economically. And a lot of people in other parts of the world want to invest in the U.S. and see that as a safe haven. Even now, I mean, maybe less of a safe haven now than it used to be, but even now, U.S. Treasury bonds are considered the safest investment out there, pretty much. And I remember 10 years ago, 15 years ago, everyone was talking about how China's going to eat the world, and here we are. China's in a 2008 financial crisis. They've got deflation. Um, they've got overproduction. They've got ghost cities there. And then the only reason we don't hear more about that is because they have a communist government that's basically controlling the media and so on. But the rest of the world is not necessarily doing better than the U.S. So important to bear that in mind and to have a global perspective on this.
Yeah. Well, we're on the hour, so I think if you have more questions, do feel free to reach out via the websites iamadvisors.com and EuroUSAFA.com.